Hey folks, welcome to second part of the video on Q1FY27 result review, where we are covering companies with excellent results. In part 1, we looked at themes like pharma, CDMO, precision engineering, data center and power. But there were several more interesting trends that emerged from the result, and that's what we are going to cover in this part 2. But again, the idea is not to simply look at which companies reported good number. We need to understand what is driving that growth, what management is expecting going forward, and whether these trends can sustain over the next few years or not. Alright, let's get started. So the fifth theme is platform companies. And I find this space very interesting because a good platform company can grow much faster than a traditional business once it reaches the scale. Because platform business has two unique advantages: network effects and operating leverage. What is network effect? So the more people uses a platform, the more valuable it can become for everyone else. Think about a marketplace like Zomato or Nykaa. More buyers attract more sellers bring more products attract more buyers, and that creates a self-reinforcing growth loop. And once a platform becomes large enough, it becomes difficult for a new competitor to replicate that ecosystem. A new competitor may be able to build the technology, but it cannot easily replicate millions of users, merchants, transactions, and data. Then second advantage is operating leverage. Once the platform and technology are built, adding another customer or transaction does not require the same amount of investment as building a traditional business. The incremental cost would be relatively small. It means the incremental revenue would directly flow into the bottom line and cash flow. And that creates operating leverage where margins expand and hence profitability expand. Again, we have discussed this theme in detail. Within this theme, first company that has reported excellent number is Nykaa. Its gross merchandise value grew 34% year on year, while revenue grew 29%. More importantly, profitability is scaling rapidly. EBITDA grew 68% with margin expanding to 8.5%, while PAT jumped to 26%. This is due to operating leverage. Just look at how companies' margins are expanding in last few years. Recently, Nykaa has conducted its annual investor day where they shared Vision 2030, where they are eyeing to grow their GMV, that is gross merchandise value, by 2.5 to 3 times in next 4 years, with beauty vertical expected to grow 2.5 to 3 times and fashion vertical expected to grow 3 to 3.5 times. Interestingly, company expect their EBITDA margin to increase from 7.5% to early to mid-teens and EBITDA to grow nearly 4 to 5 times in next 4 years. And they've shared all the growth drivers to achieve this vision that include beauty business continue to scale very well, maturing stores unlocking operating leverage, structural growth in fashion segment, then their own in-house brands from House of Nykaa, and efficiency coming from scale and operating leverage. The next company in this theme is Shadowfax. Shadowfax is essentially a technology-enabled third-party logistic company. So when you order anything online across e-commerce platform or D2C platform or quick commerce company, Shadowfax take care of the delivery part. It provides the technology, routing, allocation, tracking, and logistic infrastructure for online deliveries. So when Shadowfax grow volume rapidly, EBITDA margin can expand disproportionately, which is exactly what we are seeing in the result season. In Q1, its revenue grew 65% year on year, while PAT jumped more than 7 times to 65 crore. Just look at the margin expansion over the years. What makes the quarter even more interesting is the upgrade in management's outlook. Initially, management guided for around 28 to 30% revenue growth for FY27, but now they have revised their guidance to 38 to 40% while maintaining their existing margin trajectory. Now, what is the reason for such bullishness by management? Well, first of all, their core express parcel business is doing very well. Shadowfax has added several large enterprise customers over the last 2-3 quarters, and now these customers are ramping up volume. Company is also gaining market share as e-commerce players are increasingly consolidating with reliable logistic partners taking the market share. Then second driver is quick commerce. Shadowfax has over 50% of quick commerce third-party logistic market. The ramp up of Amazon now is an additional growth driver. Third driver is D2C is becoming a much bigger opportunity. Company now has more than 400 D2C customers, and Shadowfax has been investing in its sales team to add more brands. And then there is Prime Large, the heavy shipment business. This is growing extremely fast. So essentially, Shadowfax is no longer relying on just one growth engine. E-commerce, quick commerce, D2C, and large shipment, all scaling together. Next company in this theme is RateGain Travel Technology. In Q1, its revenue jumped 188% while adjusted EBITDA jumped 289% with a record 24.6% margin. Adjusted PAT grew 149%. Please note that this growth is heavily influenced by Sojourn acquisition. So the underlying organic growth has to be monitored very closely. Interestingly, management has also raised its FY27 outlook. It now expects revenue to jump around 3,100 crore, that imply roughly 70% growth year on year. That too, management is confident of beating this guidance. Adjusted EBITDA margin guidance has been increased from 21.5 to 22.5% earlier to 22 to 23.5%. So Sojourn acquisition has significantly expanded RateGain's business. RateGain was already helping hotels and travel companies with pricing, distribution, and revenue optimization. Sojourn specializes in digital marketing and helping travel companies acquire customers. By combining these two entities, RateGain can now address a much larger part of travel customers' journey and, more importantly, cross-sell products to each other's customer base. So the key opportunity is larger customer base plus higher wallet share plus cost synergy, which can drive both revenue growth and operating leverage. Then fourth company in this list is Grow. In Q1, its revenue grew 66% year on year while PAT almost doubled. More importantly, Grow is becoming less dependent on its traditional equity derivative business. The key shift is product diversification. Their MTF and commodity derivatives are scaling rapidly. MTF book grew 264% year on year while Grow reached 28.6% retail market share in commodity derivative. Commodity active users have now also increased to 4.35 lakh. And then there is cross-selling opportunity. Grow already has 22.7 million transacting users and 3.6 lakh crores of customer asset. So it can introduce more products to the same customer. Your MTF, commodity, bond, loan against security, wealth management, and eventually asset management. Its direct mutual fund AUM is already around 1.9 lakh crore with SIP flow growing 32% year on year versus 16% for the industry. The next theme is consumption. But it is not broad-based growth. There are specific companies that are doing well in this space. I want to focus on three companies that are benefiting from different trends within the consumption space. First is Radico Khaitan. In Q1, while its revenue grew 12%, EBITDA grew 51% and net profit jumped by 69%. The biggest story for Radico Khaitan is the transformation in its product mix. So Radico has two segments, regular and prestige and above. And this prestige and above segment is growing at a fast rate. So Radico is essentially selling fewer low-end products and a lot more premium products, which is why profits are growing much faster than revenue. Management has become even more confident on this premiumization story. It has upgraded FY27 prestige and above volume growth guidance to over 25% from 20% earlier and expect EBITDA margin of around 20% for full year. Then second company in consumption theme with good growth is Mrs. Bector Food. We have recently discussed Bector Food business in detail post Q1 result. Its revenue has jumped 16% and PAT jumped by 42%. Management is targeting mid-teen revenue growth of FY27 along with margin expansion. For long term, management want to achieve 4,000 crore revenue by FY30 and in FY26 their revenue was 1899 crore. They also want to take EBITDA to 15-16% against current margins of 12%. So there are multiple growth drivers for company that include your expansion in distribution network, ramp up of new capacity, premiumization and new products, particularly your premium cookies and health-focused product and demand revival from QSR segment after a long time. So very interesting recovery potential after sharp correction from the highs. Then third company in consumption that looks interesting is Hindustan Food. In Q1, its revenue grew 18% year on year while your PAT rose around 33%. So we are again seeing operating leverage with profits growing faster than revenue. What makes Hindustan Food interesting is that it essentially is a pick and shovel play on consumption. Instead of building its own consumer brand, it manufactures product for large FMCG and consumer companies. As these companies outsource more manufacturing, Hindustan Food can keep adding new customers, categories and manufacturing facilities. In latest con call, management has reaffirmed its FY27 PAT guidance of 200 to 250 crore that implies roughly 35 to 45% growth over FY26. The key growth drivers are food and beverage, ice cream, home and personal care, and healthcare export. Company has already secured around 240 crore of new project win for FY27 with roughly 500 crore of projects planned for commissioning. The next theme is auto. But here I want to look at specifically through the lens of electric vehicle. What makes this interesting is that we are now seeing the EV transition play out at a very different stages across companies. So first clear winner from auto sector is your Ether Energy. Revenue from operation jumped 87%, volume increased 81%, and most importantly, Ether turned EBITDA positive for the first time. The demand picture is equally strong. Pre-order jumped 158% while registration increased by 102%. And management said demand is currently ahead of available production capacity. This is important because the next leg of growth is increasingly about adding capacity rather than creating demand. The key growth drivers from here include your continued EV adoption and Ether gaining market share. Second is your Ritza and 450 portfolio that allows Ether to address both family and performance-oriented customer. And third driver is the upcoming EL platform targeted at mass market within 1 to 1.25 lakh price point that can be a game changer. This first product launch is on 29th August. Ether is also seeing non-vehicle revenue like software, charging, accessories, spare service that has reached 14% of revenue that also create an additional monetization opportunity. We have recently discussed Ether industry in detail. Then next is TVS Motor, leader in Indian two-wheeler EV market. In Q1, its revenue jumped 38% and PAT jumped 51%. While two-wheeler EV volume jumped 86% year-on-year to nearly 1.3 lakh units. Importantly, EV penetration in India's two-wheeler market has crossed 10% in June and TVS has now crossed 1 million cumulative iQube sales. What I like is that TVS is not dependent on a single EV model anymore. iQube has been expanding across price point while Orbiter gives it more affordable offering. Company is also building EVs across personal mobility and commercial three-wheeler where EV penetration has already crossed 40%. Management remains confident of growing ahead of the industry with EV penetration expected to keep increasing. Company is also investing heavily in capacity building. Also, new product launches are planned around the festive season that could provide another growth trigger. And that's what makes TVS interesting because you're not betting on a pure play EV company. You're betting on an established auto company that is successfully transitioning its existing brand, distribution and manufacturing capabilities into electric vehicle. The next theme is forging. I think forging is an interesting theme because it sits right at the intersection of manufacturing, auto, industrial and aerospace growth. Historically, forging companies were dependent on commercial vehicle, which was deeply cyclical. But now, forging companies are moving beyond auto and expanding into your industrial, off-highway, railway, aerospace and defense sector. Also, forging companies are increasingly moving up the value chain by adding machining. For example, instead of selling a forged metal part to an OEM, they increasingly supply a forged plus machined plus ready-to-use component. So that allows them to capture more of the value chain. Plus, there is strong export demand. Indian companies are increasingly winning export programs because of their manufacturing capability, cost competitiveness, and ability to supply higher value forged and machined component. Here you have three companies worth tracking closely: Happy Forging, RK Forging, and Forging. All three have posted solid set of numbers. Happy Forging management is guiding for high teens volume growth in FY27 with margins broadly at FY26 level. Then RK Forging management is targeting 8,000 crore revenue by FY29, implying roughly 22 to 25% CAGR growth over the next 3 years, with margins to improve quarter on quarter and expected ROC of 12 to 15% this year with target of 20% by FY28. Their 35% business is expected to come from export. I've recently covered RK Forging business in detail. Then Forging management has guided for around 16 to 18% revenue in FY27. Then final theme is financials. But I don't want to talk about entire financials and NBFC space because the performance has been quite mixed. What stood out in Q1 was a very specific part of the financial sector, where lenders are coming out of a difficult phase and are now seeing a strong recovery in growth, asset quality and profitability. Take Poonawalla Fincorp for example. This was probably one of the strongest NBFC performance in the quarter. AUM grew 62% year-on-year, net interest income jumped 84% and PAT increased almost 5 times. Company is benefiting from strong growth across its consumer and commercial lending business while asset quality remains under control. Then you have IDFC First Bank, where the story is more about profitability finally catching up with the balance sheet growth. Q1 PAT jumped 132% to 1,075 crore, which is bank's highest ever profit growth. And its ROA has touched the level of 1 for the first time. Although IDFC First historical performance does not instill confidence in the market at the moment, But if IDFC First can sustain Q1 performance in coming quarters as guided by management, then it can be a bank stock worth watching closely. The more interesting recovery, however, is happening in small finance bank. Equitas, for example, has come out of microfinance stress cycle and returned to profit in Q1. Advances grew 27% and PAT moved from 224 crore loss last year to 184 crore profit as credit cost normalized. Ujjivan is showing a similar recovery, with Q1 profit jumping more than 200% and management becoming more confident on profitability, raising its FY27 ROA guidance to around 1.8 to 2%. And finally, microfinance-focused players like Arman Financials and Credit Access Grameen are also seeing the benefit of improving collections and asset quality. Credit Access, for example, reported an 8-fold jump in Q1 profit to 493 crore, helped by better repayment and asset quality trend. So the common thread across these companies is quite interesting. We are moving from a period of asset quality stress, higher provisioning and weak profitability towards better collection, lower credit cost and recovery in ROA and ROE. And that's why I think this theme deserves attention. In lending business, when the credit cycle turns, earnings can recover much faster than the loan book itself because you get a combination of loan growth, stable margin and sharply lower credit cost. So overall, if we conclude, I think the interesting part about these themes is that we are seeing very different type of growth story. Platform companies are benefiting from scale, network effect and operating leverage. Consumption companies are riding premiumization, distribution expansion and outsourcing. EV companies are benefiting from rising adoption and market share gain, while forging companies are moving beyond their traditional auto exposure into export, industrial and aerospace. And finally, financials are showing something very different. A potential earning recovery as loan growth improve, asset quality normalization and credit costs coming down. But there is one common thread across almost all these companies: execution. However, a strong growth opportunity does not automatically translate into strong shareholder return. Valuations also matter, and many of these companies are already trading at premium valuation. So in the next few quarters, I think the most important thing is to keep a close eye on execution. Whether the growth guidance is actually delivered, whether margins are holding up, and whether these companies can convert their growth opportunity into sustainable earning and cash flow. And that's exactly what I try to track every week in my weekly deep dive series, where I track nearly 200 companies very closely and go through their quarterly results and management commentary and also discuss what I am doing with my own portfolio and strategies. If you haven't watched part 1 yet, do check out as well. I'll see you next video. Till then, take care.